In this video, you'll be learning about this topic.
So just to kind of make sure I understand that, if we talk about level 3, which is sort of the fiber part of this business that's laid all the fiber underground and creating all this connectivity, that investment has a certain cost basis to it. And as you just said, more and more people are getting onto the internet. So they've got this kind of fixed cost from laying out all this investment into fiber. And the more and more people get on the internet, the more money they make with this fixed cost. And therefore, they're going to start throwing off a lot more free cash flow that they can use to pay off their debt as they become more profitable. Is that sort of the right way to think about it?
Yes. In a nutshell, that's exactly right. You use the legacy business, you effectively milk it for the cash flows. You reinvest part of the cash flows into the growing side, and you pay down debt to delever the company while refinancing that debt to decrease your cost of debt as well as cost of capital.
Now that we're on the topic of debt, let's dig more into it. I'd like to focus on the interest coverage ratio. And this is the ratio that determines how easily a company can pay interest expenses on outstanding debt. And it's calculated by dividing a company's operating income by its interest expense. So whenever I do the math, I come up with an interest coverage ratio around 2. And obviously, the higher the ratio, the better. And we would typically like to see at least 5, if not 10, if a company is conservatively financed. How concerned are you about the low coverage ratio?
We're conservative investors, so debt and potential inability to cover your interest payments are a major concern. And I think the market overall is concerned about the debt level. Let's talk about that, right? Because not all debt's created equally and not all situations are the same. So this company has the ability to generate an enormous amount of free cash flow. And so that is one way in which this problem will alleviate itself. We don't think it's a current problem, but every day this company is generating cash. And what are they doing? They're paying down debt and they are refinancing their debt as well. As Eugene said, their interest savings from the things they've done are in the hundreds of millions of dollars just because they're pushing out their maturities and they're also lowering their cost of debt. That is helpful. I look at the numbers that you have that you quoted. We would calculate it slightly differently because there's so much capital associated with this business, which is they have to spend to keep the physical assets up to date and also to expand. And so slightly different metric, which we EBITDA, which is a kind of a proxy for cash flow, minus capital expenditures over divided by interest expense. And that number is more like 2.5, which is, again, these numbers are they stellar? Absolutely not. Is that certainly a concern of the market? 100%. Our contrarian perception here is that there's an inflection point in terms of growth that is upcoming. The capital that they are spending now will continue to generate even better returns because they're much more targeted in their capital expenditures. And the cash flows they generate can more than offset, where they can pay down debt, they can pay a dividend, they can pay their interest. And then over time, as EBITDA grows, which is kind of the cash flow metric that we're using here to measure the debt, as EBITDA grows and that debt profile, the total amount of debt declines, then those numbers are going to start looking a lot better. Right now, on a net debt to EBITDA basis, EBITDA being our proxy for cash flow, they're at 3.7 times, which is certainly not that high. I mean, we think anything over 5 times, depending on the business, but 5 times is a number where you start to have to really worry about it. Given the cash flow profile, given that management is absolutely hell-bent on paying down debt, given their ability to reduce their total interest expense, and the corollary to that, or what happens associated with that, is that you get higher free cash flow. There's a virtuous cycle of debt pay down and lower debt costs and then better ratios that we think will be really helpful for the stock. So we never want to downplay how much risk is associated when you're talking about $35 billion in debt and a business that has a shrinking component. But I think our contrarian perception is that that it is nowhere near as big as an issue as people are giving it.
So you pointed out that the management is aggressively cost cutting and also refinancing the high yield debt. So that brings us to CEO Jeff Story. Jeff Story is an interesting character in this story because he was CEO of Level 3, the smaller portion of this now merged company. And before that, he had experience at companies like Cox and Wiltel. And you mentioned you have a lot of faith in Jeff specifically. So I'd like to cover him a little bit more. How do you measure his performance and how much do you factor management qualitatively in the overall valuation of the company?
In terms of measuring his performance, I would point people strictly to the free cash flow number. So the weird thing about this company is that given that level 3 has publicly traded debt, level 3 also still puts out its own independent financials. So while you can have a consolidated Lumen 10K, you could also look at the annual results for the underlying level 3 business, which allows you to break apart level 3 from legacy CenturyLink. Just give your viewers some quote or some metrics behind how to judge Jeff Story. When Story came in to be the CEO of the combined entity, the legacy CenturyLink had a free cash flow number of roughly $1.627 billion. That was in 2016. He came in at the end of 17, so let's just use 18 as a starting point. From 18 and 19, he's effectively stabilized and slightly even grown free cash flow, while at the very same time, CenturyLink has lost, call it 10 to 12% of its top line. So how do you judge Jeff Story? Well, you judge him by the fact that within that melting ice cube, he's managed to cut enough costs to effectively stabilize free cash flow in the face of a shrinking top line number, which is an impressive thing and goes back to something that we've mentioned several times, which is his kind of cost cutting chops. That's one way to measure him. The other way to measure him is we internally will have a metric that we track, which is called our NOPAT, return on invested capital. Since he took over the entity, that ROIC measure has gone up from, ROIC is a return on invested capital, has gone up from, call it 8 to 9% when the old legacy CenturyLink management team ran things, to roughly 12 to 13%. Again, this is a way for us to kind of back of the envelope gauge whether or not whatever he's doing, including the CapEx that he's spending, is that a net positive for shareholders. I would point to both of those things as showing people that this person is a fantastic leader when it comes to cutting down unnecessary, inefficient fat that a larger corporation might have, as well as deploying the next marginal dollar into the highest and best use for the underlying shareholders.
What's happened to the stock price? It's been a disaster. And for us, that's the opportunity. You have good management with a business that's about to hit an inflection point, and it's trading at a valuation that is way below what we think it should be or what comparable companies trade at. But to get to your question, these are independent decisions within our process. We evaluate the business separately from the people, separately from the valuation, because we want all three pillars to be pointing in the right direction. And so we've done a fair amount of work on Jeff over the number of years, and we don't have any concerns that he's not completely aligned with shareholders. I'll point out that he was going to retire, was basically forced to come back into this role. He's 59 years old. I don't think he wants to do this forever. I'm going to put it out there that this is not public information. They haven't said it, what I'm saying, but our supposition based on the name change, the branding change, is that the company is in the middle of a long process of actually undoing this merger. Because very simply, as Eugene was talking about, a business like CenturyLink should trade at a lower multiple. A business like Level 3 should trade at a higher multiple, and suggest comparable transactions a much higher multiple. And those two businesses don't work together in Wall Street's mind. But if you separate them, basically undoing what was an ill-fated marriage from the very beginning, that's how you create a lot of value for shareholders. And so they haven't said that specifically, but I do think that you've seen signs that they've been very thoughtful about that. And when we've talked to the company, they have expressed an openness to do anything that adds value for shareholders, including transactions, spin-offs, things that would be more of a catalyst for value creation.
And I would just add to that in terms of, we do a lot of work on proxies, and people tend to skip over proxy materials, I feel, to their detriment. And proxies are fantastic ways for investors to get a sense of what is this person that's the head of the company, how are they incentivized, so what are they going to focus on? So Jeff Story's incentives are threefold. One, most of his comp comes in the form of things tied to EBITDA and free cash flow growth. I believe it's 90% of his short-term comp is based on that. And I believe he has restricted stock issuances that are also based on the EBITDA profile of the company. That's one. Two, after the merger, I think he wound up owning 3 million shares, if not a little bit more. So you can do that math, right? So a stock that used to be $25 to him is a whole heck of a lot of money. It doesn't matter. Even if you're a billionaire, you'd still think $75 million is a lot of money. So he's incentivized just from long-term shareholder ownership. And the last part is I think that the board also added in a TSR, total stock return, long-term compensation metric, which means that while you can argue that he's done a fantastic job on the operating side and, he's done all the cost cuts and stabilized cash flows and done all these things, yet if the shareholders aren't getting the benefit of all of that, he's not going to get paid at all, which goes back to Ben's point about should this be actually kind of split back up into two different entities? And I'm guessing Jeff's story would be 100% for it because he certainly would benefit greatly, personally.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.